The crude oil price collapse of 2015 has continued into 2016, with the price of oil plunging to a 12-year low of just under $30 per barrel as a consequence of a perfect storm of falling demand, primarily due to the slowing Chinese economy, and relentlessly rising output that is not just limited to the usual suspects, i.e. OPEC, but is as the natural consequences of the fracking boom that continues to ripple out from the United States to across the world well into 2016. This video analysis will seek to update my last in-depth analysis of 1st September 2015 that concluded in expectations for the oil price to have entered into a trading range of $64 to $40, with the main risk being of a downward spike to $30. The severe oil bear market has not only caught most market commentators off guard, but has had a devastating impact on the oil producing corporations and nations that are heavily reliant on high oil prices, such as Russia, the Gulf states and other emerging markets, which rely on their energy sector tax revenues to finance government spending, and of course Britain's very own Scotland, that 15 months ago was seriously considering committing economic and social suicide, i.e. independence referendum, which at the time I warned in a series of articles and videos that the Scottish nationalist fanatics were effectively trying to convince the Scottish people to jump off the edge of a cliff, committing economic and social suicide. Well, 15 months on, and this is what an independent Scotland's fantasy oil revenues would now be looking like, which for the duration has been met by delusional propaganda from Scottish nationalist vested interests that the fall in the price of oil was always just temporary and that a rebound was just around the corner. Instead, the oil price has continued to grind lower, slowly turning the Scottish oil industry and independent finances into dust, as the fantasy expectations for the oil revenues of 11 billion a year would now have resolved into a loss of 2 billion a year. That today's Scotland economy is only being kept alive by a 9 billion annual subsidy from England that is being supplemented by emergency life support for Scotland's oil industry to the tune of £2 billion per year, which illustrates the catastrophe that Scotland only just avoided by a whisker. And despite heavy English support of the Scottish economy, the oil price crash has resulted in the Scottish economy effectively flatlining during 2015, which compares against estimated UK GDP of 2% for the year. Despite this, the Scottish people mostly remain in a delusional state, as evidenced by expectations for another probable landslide for the nationalists at the May 2016 Holyrood elections, as apparently the lack of economic growth in Scotland is somehow by default England's fault, rather than that of the clueless nationalist fanatics whose blinkered view remains determined to destroy Scotland. The recent news of another 4,000 job losses at BP, that includes a fifth of its North Sea workforce, further illustrates that the crisis that Scotland is facing, as there is no sign of an oil price rebounding to anywhere near the $113 the likes of Alex Salmond were fantasizing about, as required for Scotland's expensive offshore oil industry to recover. Instead, Scotland's oil industry is being slowly ground to dust, with an estimated 1/3 of the oil sector jobs lost to date. The bottom line is that Scotland's North Sea oil industry appears to be in terminal decline because it just cannot compete against the likes of fracking. The oil price collapse is having a devastating impact on all the world's major oil producers, so it's not just a case of what is the break-even price for production, but the price necessary to finance government budgets that have now fallen into deep deficits, which has been triggering increasing global instability as the price has slid to $30. In fact, the budgets of virtually every major oil producer requires an oil price north of $80 just to break even, with several such as Russia requiring $100 plus. Furthermore, the oil price slump of 2015 has played a large part in sparking economic mass migration out of the African oil producers such as Nigeria, whose government requires an oil price of about $120 to balance its budget. Russia, the world's third largest oil producer and second largest exporter, remains in war mode so as to divert the attention of the Russian people away from an economy in meltdown as Tsar Putin turns his military ambitions far beyond the Ukrainian war zone by expanding their military operations into Syria under the cover of fighting jihadists, when the truth where Russia is concerned has always been one of first countering the US military empire and secondly to undermine the European Union at every opportunity, which have always been seen as the two main threats to the Russian empire and not some high on religion fanatics roaming the Syrian desert. Thus, Russia's war in Syria is primarily concerned with doing damage to the European Union and secondly undermining the US presence in the region. To illustrate the crisis that Russia is facing is the fact that Russia requires an oil price north of about $110 to balance its finances, and for every $1 below 110, Russia loses an estimated $2 billion in revenues. Worse still is that the Russian oil industry needs an oil price of $20 just to break even, which could be hit this year. With crude oil currently trading at $30, that's a huge revenue loss of well over $160 billion per annum that has plunged the Russian economy into recession for the whole of 2015, that now looks set to further intensify during 2016 as Russia's hard-earned foreign currency reserves look set to have completely evaporated before the end of this year. Whilst the cowering in fear population may be calm today, however, if the oil price falls or fails to recover, or worse, dips to as low as $20, then Russia is in for a perfect storm of a totalitarian state on the edge of major civil revolts as the population panics, prompting troops on the ground Ukraine style. Most will be unaware that China is the world's fourth largest oil producer, though all of it for domestic consumption and even more is imported. The economic slowdown in China is one of the primary drivers for the collapse in the global oil price, which is also making itself felt in the global stock markets. So whilst lower oil prices should act to support the Chinese economy, other drivers such as overcapacity far surpass the low oil price stimulus that shows no signs of recovering for much of 2016. In fact, low oil prices will be hurting the Chinese producers and refiners just as badly as Western oil majors that likely are already being propped up by the Chinese government, which means, despite being a heavy consumer, China also needs an oil price floor of about $40, below which the pain tends to outweigh the gains. So China does not look set to spark a fundamental turnaround in the crude oil price demand for much of 2016. In terms of instability, a weakening economy is likely to further encourage the Chinese empire, emboldened by a new fleet of aircraft carriers, to continue to assert its dominance over the Asian region, with the most evident example of it is the construction of artificial islands on reefs in the South China Sea, an area claimed by several nations, including the Philippines and Malaysia, that could prove a flashpoint between US and Chinese vessels. The continuing thawing of the Iran-US relations implies the potential for a huge increase in supply of oil out of Iran, which has the world's fourth largest oil reserves and second largest gas reserves. Whilst it will probably take the whole of 2016 for Iran to ramp up production by even anything near 1 million barrels a day, However, a more immediate supply boost will likely come from the release of 50 million barrels of oil in storage for an hoped for economic boost, which is fast evaporating given an oil price of just $30, which is well below the minimum of $70 required for Iran to cover government spending. The lifting of the Iranian sanctions in response to reducing its nuclear, plutonium and uranium stockpiles, as well as dismantling some infrastructure such as reactors and centrifuges, is going to result in a huge economic boost for the Islamic Republic, not only in terms of trade, but the release of up to 150 billion of frozen Iranian assets that is now free to be spent on both armaments and upgrading Iran's oil industry's production capacity. Whilst Iran so far is complying with the agreement for nuclear disarmament, being great news for the world, as I warned it would be one of the several necessary steps so as to avert the gallop towards Armageddon in my video of November 2013. However, the usual suspects have once more cropped up to spout propaganda criticism in an attempt to undermine the trend towards a more peaceful world, such as the Israeli Prime Minister conveniently ignoring the fact that Israel has over 300 nuclear weapons, more than enough to destroy the whole of the Middle East and Europe, all for the purposes of fulfilling the Jewish messianic end times prophecies. But back to the oil price. Even if Iran chose not to increase oil production, just the ability to do so will be enough to keep oil prices depressed for virtually the whole of 2016, especially given the internal and external pressures pulling on Iran to raise more revenues, such as Iran's proxy wars against Saudi Arabia in Syria and Yemen, whilst at the same time retaining its influence and network of control over Shia Iraq. Those who have been looking to Saudi Arabia for signs for a cut in production are being greatly disappointed, as instead Saudi Arabia has ramped up production to 10.2 million barrels a day compared to 9.6 million barrels a day a year ago, and thus further contributing to the world's crude oil glut that is seen by much of the media as part of a war on the US shale oil industry aimed at annihilating the competition, such as that from the fracking industry. However, despite $620 billion of reserves, most of which is parked in its sovereign wealth funds, Saudi Arabia is not immune to the instability triggering consequences of the collapse in the oil price, which is seeing Saudi Arabia's wealth disappearing at the rate of about $100 billion per year, as the kingdom is reliant on oil exports for 85% of its revenues. In fact, rather than reining in government spending, Saudi Arabia is engaged in two costly major proxy wars against Iran in Syria and Yemen, and each passing day brings increasing risks of a hot war between Iran and Saudi Arabia that would probably trigger at least a temporary speculator-driven spike in oil prices, especially given that despite all of the hype, militarily Saudi Arabia is just no match against Iran. For instance, Iran's population is near 3 times that of Saudi Arabia, and thus has plenty more cannon fodder to throw in a war of attrition, which is illustrated by Iranian militias totaling 2.25 million against Saudi Arabia's 250,000. What's worse for Saudi Arabia is that it's not a done deal that most of the Saudi military will be willing to die for the Al Saud family dictatorship, and so given an Iranian invasion may choose just to melt away into the civilian population, biding their time as the Iranians dismantle the Al Saud dictatorship, for them hoping it will result in an Arabia that is free of the Al Saud leeches. In fact, it's even possible that there could be a military coup against the Al Saud regime, especially if war between Saudi Arabia and Iran appeared imminent, so as to prevent the destruction of Saudi Arabia's oil production and refining infrastructure. The reality of Saudi Arabia is one of a regime that is rotten to its very core, that literally has hundreds of wannabe Al Saud, Saddam Hussein types running around trying to stoke the fires of sectarian conflicts both in neighbouring states and within Saudi Arabia itself, who are increasingly wielding the power against a fragile centre that sows the seeds for what is unthinkable today, that of a revolution or even a civil war, let alone the possibility of a hot war against Iran, which means no matter how loudly other OPEC members such as Nigeria scream at Saudi Arabia to cut oil production, it's just not going to happen. In fact, I would not be surprised if we found out in a few months' time that Saudi Arabia has further increased production in an attempt to monetize the oil in the ground, whilst it still has customers for it, and ahead of Iran flooding the market and thus potentially driving the oil price lower still. This illuminates why Saudi Arabia this week announced intentions to put its oil industry, Aramco, on sale, which is because it understands that the nation's 266 billion barrels of oil in the ground could become worthless long before it can be produced and sold. So instead, the Al Saud family is trying to forward sell Saudi Arabia's oil reserves to clueless investors preparing to run off with the nation's loot, as is usually the case with dictatorships that fear loss of power. So by the end of 2016, some of these Al Saud wannabe Saddam Husseins will have made enough a name of themselves as they engaged in violence both within the neighbouring states and Saudi Arabia, that will make it into the mainstream media as they leave their fingerprints of regional instability throughout the region, when increasingly there will be a blurring of the lines of between Islamic State and the Saudi regime, as the recent executions were just a taste of. Meanwhile, Iraq is still desperately trying to rebuild its devastated cities after the US and allies went on a decade-long rampage across the nation, all on the basis of lies such as the war was for 9/11 or that there were weapons of mass destruction ready to hit Europe within 45 minutes, the consequences of which still continue to plague Iraq to this day, which remains a divided nation of between Sunnis and Shias and Kurds. After America's departure, the one hope that Iraq had towards building a better, more stable future was Iraq's huge oil reserves, which given a price of $100 would be more than enough for the central government to paper over the cracks and buy off the various competing factions with petrodollars. However, again, despite a low break-even price of $12, $30 is just not enough to meet the requirements for a fragile Iraq, which implies that 2016 could turn out to be just as bad a year for Iraq as was 2015, as the factions such as the Kurds and various Sunni and Shia militias attempt to seize control of the oil producing regions, resulting in continuing sectarian warfare. In fact, the Kurds by the end of 2016 could be coming to be seen in a similar way as ISIS is today, as Kurdistan seeks to control Iraq's northern oil fields and take all of the revenues for themselves, therefore risking a Shia Iraq-Kurd war. The consensus view in the United States is that Saudi Arabia is engaged in an oil war to knock out America's shale oil industry. However, when one looks at the facts, the reality is more like a US oil war on Saudi Arabia, as evidenced by the fact that it is the United States which has effectively doubled its oil production over the past 10 years from 4.5 million barrels a day to over 9 million barrels per day today. That virtually rivals that of Saudi Arabia, which is producing little more than it was 10 years ago, i.e. 10.2 against 9.7 million barrels per day 10 years ago. This view, whilst obvious, remains invisible to a propaganda-driven mainstream press that, instead of reflecting reality, instead peddles and regurgitates the view that it's all Saudi Arabia's fault, which, as my earlier Saudi analysis illustrates, is being financially wiped out by the oil price crash, as low oil prices risk an implosion of the Saudi regime. So it's not for something that the Saudis would risk by instigating a war on the US shale oil industry. The US shale oil production peaked during 2015 at approximately 5.7 million barrels per day, and today it has declined to 5.15 million barrels a day, with expectations for the decline to steepen during 2016 in response to a sustained low oil price, resulting in a bloodbath amongst the US shale oil industry that could kill off half the industry this year, leaving output at least 2 million barrels per day lower at approximately 3 million barrels a day. Therefore, US total oil output could fall to approximately 7 million barrels per day by the end of this year. Whilst the majors should fare better, having locked in prices for multiple years as high as $60, nevertheless will be scrapping hundreds of billions in exploration and drilling projects during 2016, resulting in further job losses. So on the basis of the fundamental analysis, there is little sign for an end to low oil prices anytime soon, as will likely be a slow grinding process of wiping out approximately half of the US shale oil industry, supplemented by significant cuts amongst the world's oil producers, even if OPEC appears determined to keep pumping flat out, which means that whilst the crude oil price is probably near the bottom, however, it is unlikely to spark a return to anywhere near the likes of $100, with even a risk that the crude oil price could sink lower still, as given these fundamentals, a spike to $20 is very possible, and what was thought as impossible, $10, is also possible, which means that whilst the crude oil price is probably near the bottom, however, it is unlikely to spark a return to anywhere near the likes of $100, with even a risk that crude oil price could sink lower still, as given these fundamentals, a spike to $20 is very possible, and whilst it is difficult to imagine the oil price trading as low as $10 a barrel, as some are forecasting, i.e. Standard Chartered, nevertheless it is no longer impossible, especially given the fact that Iran has now had oil export sanctions lifted. The bottom line is that a sustained low oil price, far below the levels necessary to finance government budgets, means that something major is going to give during 2016, where not even the likes of Russia or Saudi Arabia or Iran are immune. The current trend is towards an escalation of the conflict between Saudi Arabia and Iran. However, either one of these totalitarian nations may implode into civil war during 2016, much as we have seen with Syria and Libya during the past few years. And even Russia is not immune to such a fate, which I'm sure has many Western intelligence agencies busy trying to engineer Russia's demise, much as Russia is busy trying to disrupt the European Union and American influence in its bordering regions. Then there are the myriad of other nations across the world that are being destabilized by low oil prices, and at the top of that list is Venezuela, that is primed for a revolution that I'm sure the CIA will be busy stalking all year. Whilst the producers and exporters are hurting, the oil consumers and importers are experiencing an oil price bonanza, as the drop amounts to an effective transfer of wealth from oil producers to oil consumers to the tune of over $1 trillion per year, a huge economic stimulus for every net importer of oil that has probably saved the Eurozone economy from re-entering recession during 2015. Sectors that most benefit from a low oil price are transportation, travel, food, and of course the auto sector. However, on the other hand, we have the oil producing nations running huge deficits, drawing down the reserves held in Western markets, i.e. liquidating assets and investments so as to finance their budget black holes, and likewise, instead of providing capital to support the debt markets, are now issuing their own debt to sell on Western markets, thus competing for limited capital and thus forcing up bond market interest rates. So fundamental analysis paints a bleak picture that suggests it will literally take a major oil producer such as Saudi Arabia or even Russia imploding for any significant turnaround in the oil price, which would be a black swan event, so it's not easy to pin down when, where and how. For instance, it could just as well be the Nigerian economy that goes up in smoke, triggering many of the 175 million or so Nigerians to seek economic asylum in Europe. The starting point for technical analysis of the crude oil price is my last in-depth analysis of 1st of September 2015 that concluded in expectations for a trading range coupled with the risks of a downward spike to $30 that this analysis will now seek to update. Elliott wave analysis. The September 2014 high of $112 was clearly a fifth wave peak that has subsequently ushered in a 5-wave decline to $29 that should be imminently near completion and likely to resolve in an ABC correction higher towards $50 over the next few months, which is likely to be followed by a test of the lows in either an ABC or ABCD pattern that would set the scene for a probable higher bottom and the start of a new oil bull market sometime during the second half of 2016. Trend analysis. The last close recovered to just back above $30 at $30.6. The panic in the oil market is evident on the break below $35, which pushed the oil price out of its channel that had contained the oil price since the September 2015 low. The current severe downtrend extends all the way to zero. However, that's not going to happen, as whilst the oil price could continue hugging the downtrend line to perhaps as low as $25, ultimately a break above the downsloping line will propel the oil price into a new trading range of approximately $50 to $30, trending in the direction of $50, and we are probably less than a month away from this upside breakout. Support and resistance. The oil price does not have any support, so before an upwards break takes place, the oil price needs to form a bottom, which should take about a month to form, be it at $29, $25 or even $20. Overhead resistance lies at $35, then 48 to 51, then 60 to 64. So a break above $35 will propel the oil price towards resistance at $48 to 51 before a likely retest of the $35 area. MACD. Whilst the oil price has been sinking like a stone, the MACD indicator is showing a positive divergence which is supportive of expectations for a trend higher. Overall, the MACD is supportive of rising prices ahead, even if it's within a tight trading range. Seasonal analysis. My last seasonal analysis proved remarkably accurate as of my mid-September analysis, i.e. for the oil price to reverse before the end of the year to target a retest of the $37 low. The seasonal pattern is for crude oil price to bottom during February, then march higher into September before turning lower into December. Current price action would tie into a February bottom, however a rally all the way to September would be suspect. US dollar. It is often taken as granted that commodities tend to have an inverse relationship to the dollar by virtue of the fact that internationally commodities are priced in US dollars. A strong dollar cuts the price of commodities in foreign currencies, therefore this should most of the time be reflected in the price charts of major commodities such as crude oil. In addition to dollar pricing, the crude oil price has literally collapsed, that in times of economic uncertainty, a falling oil demand prompts both flight to safety, namely the world's reserve currency, and acts as a stimulus for the US economy and thus the US dollar as a consequence of falling energy costs. The crude oil price has clearly continued to exhibit a strong inverse relationship to the US dollar. My US dollar forecast for 2015 proved accurate for most of the year, forecasting that the dollar would be capped at around $1.99, though the last 2 months showed significant deviation as the US dollar rallied into the end of the year rather than declining towards 94. Whilst my US dollar forecast for 2016 remains pending, however, the US dollar is clearly in a bull market, which at worst would resolve to a trading range of between US dollar 100 to USD 90, but more probably is looking to break out higher, which would continue to act as a drag on oil prices for some time. So crude oil is unlikely to find any boost from a falling dollar. The overall picture being painted by this analysis is expectations for 3 trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range, followed by a second retesting range, and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within 3 distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December to target an end-year price of approximately $48 as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however, the long-term trend given the likes of climate change is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much as their oil out of the ground as possible and sold off before they run out of customers. Oil stocks. Back in September 2015, I warned to give oil stocks a miss for a year or so as to allow for the dust to settle, as many players with unserviceable debt mountains are going to go bust. And given what has subsequently come to pass, that message remains intact, which means even if the oil price bottoms, it's probably best to still wait it out until at least September 2016, as given the forecast conclusion for sustained trading ranges, the crude oil price is unlikely to be going anywhere fast that warrants piling into oil stocks at this risky stage. And this video analysis is based on my in-depth analysis article posted at the Market Oracle website. My next in-depth analysis for the stock market will seek to map out a trend for several months and probably for the whole of 2016, so ensure you are subscribed to this YouTube channel to keep updated on ongoing new analysis. However, having traded markets for over 30 years now, I can say that today's market neither resembles 1987, 2000 or 2007, which implies to expect something different to that which transpired following each of those market tops. So pending the final conclusion of my ongoing series of in-depth pieces of analysis, my view is that the stocks bull market is currently undergoing its most severe correction to date, which has further to go and may technically turn out to be classed as a bear market, but nothing on the scale of the last two bear markets in terms of percentage declines and duration. In fact, the next few weeks could prove to be a great buying opportunity. But subscribe for my actual final analysis and trend forecast.